Well, welcome to Business 101 Part 3. As always, if you love our presentation, want to show it off to your friends, play it at a dinner party, we will be posting it to our company's YouTube page. If you have any questions along the way while we go through the presentation, please feel welcome to go ahead and type those into the chat and we'll address them as soon as possible. The reason that we put together this series was to help those new business owners so that they can start off on the right foot. There's normally lots going on, lots of work, so we thought this may be helpful in getting people started off in the right direction. As always, we will be doing a client example with pseudo Catherine, someone who has a English master's, along with a good ability to make jams, wanted to turn her passion project into an ongoing business. Wanted some advice along the way, and she'll be jumping in with questions as we go through the presentation as if she were a client. She'll of course be staying with Hawk Kruse and Associates. She won't use this information to leave us to start a very business, but
we'll really have to see about that last part. Yeah, absolutely. And I think one thing that we always try to mention is to be sure that, like, if you are listening to this presentation and you know more than Catherine, the client, we're hoping to be building on this as we go. So don't feel like the information is immediately like too rudimentary for you. So we'll get started.
Absolutely. So today we'll be going over reading your financials. Once again, last week we hit on the balance sheet. We'll just do a quick refresher on that to make sure everyone remembers, in case they didn't watch the last video multiple times for fun. We'll also be going over the two other major financial statements, the income statement and the statement of cash flows. And then we'll wrap it up with just a quick review of accrual versus cash style accounting. We won't get too into the weeds on that one, as it can be a pretty large rabbit hole to go down, but just kind of give you the high level of what each one does and how it can be used.
Today is one of the last kind of basic webinars we're going to be doing about reading your financials. In a couple of weeks, we're going to be talking a lot more about customizing them for what you're looking for. So stay tuned, and definitely, as Jordan said, if you have questions as we're going through the presentation, like, please feel free to send me a chat, or you can click on the question and answer button.
Yep. So once again, this is the balance sheet that we're looking at. This is a snapshot of your company's financials in time. Whenever I'm looking at a balance sheet, the thing I'm looking for first is what is the quality of the financials that I'm reviewing. So if I see cash balances at negative $70,000, credit cards at $430,000, the company is either in extreme financial distress, or there's a possibility that maybe the books haven't been done correctly. And a more positive note of how you can look at it is you can see the available current assets, cash, receivables coming in that can fund future projects for you, along with your current liabilities that you'll need to be paying. So if, for example, I see that I have cash of $13,500, as we do here, and I've got accounts payable of $6,500 and a credit card outstanding of around $1,300, and I know that I don't have any large expenditures coming down the line that maybe I haven't accounted for yet, I may have the opportunity to invest in some new equipment to make me more efficient, more productive, etc.
Excellent. Any questions on the balance sheet before we move on? How often would you say you would run a balance sheet? Or is it something like you just said when you're looking to purchase, or like you would run it for a specific reason as opposed to just like on a regular basis?
That's a good question. So it depends how often you're updating your financials. I think it's somewhat common for people to do kind of a month-end review of their financials. And that's whenever I take a close look at it, because I know I'll have my bank accounts reconciled and my credit card account so that the financials overall are good. You can look at it in an interim period. There's a possibility, if you don't have anything to reconcile to, that there's some errors there that you haven't caught yet, but overall it's still possible.
And the big thing for that, like we said last time, was negative numbers are a pretty good indication that something is off.
That's right. So some negative numbers are okay. So if we look at this balance sheet, we have accumulated depreciation, which is a standard negative number. Current year net income being negative is not unheard of, especially for a startup business. So once again, that wouldn't necessarily be a concern for me that the financials are incorrect either.
All right.
So the first one that we're going to look at is a profit and loss, an income statement. That's the most readable, understandable one for a business owner normally. What that shows is over a set period of time, and you determine that period of time whenever you run the financial statement, whether or not your company was profitable. Profitable means whether or not you had revenue in excess of expenses. It doesn't necessarily mean you end up having positive or negative cash flow. Other things can impact that. But that set period of time will show you whether or not your company has performed financially.
When are you likely to run this type of a report?
When a what?
When are you likely to run this type of a report? Like, what are you looking for?
I would run it anytime I ran the balance sheet. So whenever I run financial statements, I typically run them in the same sets as I run my balance sheet. So all together, normally statement of cash flows, profit and loss, balance sheet, all together at the same time. If you wanted to look at your profit and loss for the week and you feel confident that you are a good bookkeeper, you certainly can. Absolutely.
Should I go to the next slide?
Yeah. So this is a standard profit and loss. What you're going to see here is we have income statement for the month ending May 31st, 2020. That would imply to me that it's either an income statement for May itself. It could be for January through May 31st, but it looks to me like that's going to be just for the month of May. So once again, it's not necessarily representative of your profit for the company for the whole year, but just that one period, just in May. So we're going to be looking at sales, which is, as you earn money. So if Catherine sells 125,000 $1 jars of jam, she's going to have sales of $125,000 here. If those jars of jams cost $71,000, that's what you're going to see in the cost of goods sold section, leading you to your gross profit. Your gross profit is a very important number because that is the profitability of your product without regard to kind of the back office or business growth expenses. Can my jar jams make money by themselves? If I see a negative gross profit, it implies to me that maybe I have underperformed on my sales, or maybe I'm using a method of accounting that isn't necessarily representative of the reality of what's happening. Or it could mean that I need to renegotiate with my suppliers or find new suppliers so I can decrease that cost of goods sold.
And when you say like back office, like it's not reflective of other back office things, like what does that mean? What are some of the
Right.
examples?
So I would not expect to see advertising or internet charges or anything you basically use to run the operations of a business. So computer software costs, things like that. I would strictly look for items that directly feed into creating the product that I'm selling.
So like payroll is another thing that wouldn't be included in that.
Payroll, it could be. So if you had, for example, a whole production facility, it's possible that, yes, you could include that in cost of goods sold. That part's a little bit subjective and people just have a preference in it. Some industries have requirements of what is put into cost of goods sold. But for a jam making business, I would say, if, for example, you have someone you pay that goes to the farmer's market to sell your product and you're going to send them every Saturday, regardless of the volume you think you'll produce, you could put that into cost of goods sold. If you had an office worker such as me doing your accounting for you, I would not consider that cost of goods sold. I have nothing to do with the production of that product.
Awesome. And like you also see those things like farther down on the line under operating expenses, it looks like.
Yeah. So if you're paying rent for a garage, a temperature controlled garage to store your jams, that I would expect to be in the operating expenses.
Just to be clear, I would never store my jams in a garage. They would of course be in a temperature controlled environment that is not referred to as a garage.
Well, that's why your rent's so cheap though.
Excellent.
So that's the basic overview of profit and loss. So we have put one together for Very Good Jams as well. If we want to go on to the next slide, Catherine. So this is Very Good Jams profit and loss for January 1st, 2022 through May 31st, 2022. So we saw that last slide. So that kind of goes back into why it's important to develop a good chart of accounts. Whenever I look at this, I see blackberry sales, strawberry sales, coffee cup sales that she includes at her stands, jars, jams, cost of goods sold. That's more reflective of the actual operations of your business versus the other one was pretty generic. So this gives us a little bit more of a story in terms of maybe where some of your cost centers are. So whenever I look at this one, once again, we start with revenue always. We've got $9,900 of sales so far this year. Most of that's coming from blackberry sales. I assume we haven't started up on strawberry because they are just getting into season. So maybe you haven't sold a lot yet. But if you compare this next year and you saw, in fact, my blackberry sales are down by 50%, you may wonder, well, are people tired of blackberry jams in the state of Missouri?
They're not.
Is it possible that maybe I've gotten a bad batch from my supplier or my bushes aren't producing as much sugar per berry as I was hoping? And I need to maybe hire out an agricultural person to take a look at that.
Maybe the bushes were blighted.
Maybe
like
the
maybe
bushes
they
were
got
blighted.
disease.
Yes. So comparing revenue between different years is very helpful for determining maybe why your business is operating more successfully or less successfully in certain areas than it has in prior years. If Catherine has coffee cup sales that go down to 0 next year, could be because she can no longer get the coffee cup that she was selling, or maybe she has sold to her entire customer base a full set of coffee mugs and she's not necessarily going to be selling any new ones soon. So she maybe doesn't order as many.
What about so the balance sheet you can consistently refer to as a snapshot in time? Is the income statement the same thing? Is it the same concept, or would you say it's different?
It's different. A balance sheet is a snapshot of my assets and liabilities as of now.
Right.
This is my profitability over the course of X period. So I can run a profit and loss for a day and it may show a profit of $300, and I can run it for 6 months and it may show it for $400,000. So getting a significant period of time that is actually meaningful to you is important whenever running this report.
And it's important for people like me to note that every single line on this on this income statement is something that Jordan made, kind of adapted for my company in general. What did you say was kind of your rule for how big a chart of accounts should be?
I try to make a chart of accounts large enough that I can get detailed information that's helpful to me, and small enough that my profit and loss and my balance sheets don't exceed 1 page. If it's longer than that, it gets harder to review. I can tell you, if I look at a profit and loss that's 2 pages long, it's much, much harder to actually review the overall financials than it is versus 1 page.
And next week, we are going to be talking about charts of accounts and suggestions kind of across the board. So if you're looking to start your own chart of accounts, or if you're ready to get started, next week is the session for you.
Yeah.
Don't want to give too much away.
Yes. So as we look further down, now we're getting into the cost of goods sold section. We see jars and jam, which jam is the actual product in this case, which you're filling the jars with. So whenever we're looking at cost of goods sold, what I'm really looking for is, do I have a healthy gross margin? If I see costs of goods sold that are borderline what my revenues are, it means that I'm going to have to sell a lot of product in order to make a living off of it. If I see a healthy gross margin, which your gross margin is industry dependent in terms of what it should be. I don't know that this is a good cost of goods sold for a jam business, to be candid. This was something I just made up. You would have to look into some sort of, you would have to look it up on the internet, essentially looking for kind of how profitable you should look to be in your certain industry. So the good news is that Catherine here has a good gross margin. She's made $4,000 on her sales so far this year, a little under 50%. So that's pretty solid. The next part, whenever I'm looking at a profit and losses, I'm looking at the operating expenses. And what I'm looking for here is, what can I count on as recurring charges? What are outliers that really aren't going to impact me going forward for things like budgeting, things like that. So your operating expenses, you spent $500 on advertising. If that's what you have to spend in order to advertise on some sort of AM radio station, that's going to be a recurring charge. That's reasonable. I see bank fees of $950. That seems high to me, especially considering you're operating out of a farmer's market where a lot of people are paying in cash. So that's something where I might look into the detail and see what's all in there. If I looked in there, what I would also see is Catherine also took out 2 significant loans, as you remember, to buy the land and the equipment. So having a high bank fee for this period is actually pretty reasonable, not necessarily something that would be expected moving forward, but something that was significant to where we want to make sure that something's not wrong, essentially. You also have some car and truck expenses, which are pretty insignificant. That would seem normal to me. You have some depreciation that you've started taking on your equipment. This amount, we're going to pretend is correct in this case. I made it this amount just because I liked the nice round number that was easy to use, but you began depreciating your equipment, which is a good thing. And then we would keep looking down. We would see jam stand decor. $800 seems reasonable for what jam stand decor is. If I was looking at the overall profitability of my business, I've lost $3,800, or I have a net loss of $3,800. Jam decor might be one of those things where I would ask Catherine as an outside advisor, do you need to continue spending more money on jam decor, or do you already have a good customer base going through to maybe we can back that off a little bit? And she may say, no, Jordan, it can still grow. I need that jam stand decor in order to attract those new customers that love the flashy, whatever you would put on your, what would you put on your jam stand, Catherine?
I wasn't prepared to answer this question.
Okay. Anyway, she may also buy things like seeds. Whenever I see a seed expense, I would say, as an outside advisor, Catherine, that doesn't seem like a lot of money for seeds, considering you're supposed to be producing lots of berries in order to actually produce these jams. So that might be something that I would follow up on, where the business owner would know, actually, Jordan, I already have a significant amount of blackberry bushes planted.
Mhm.
And then the strawberries, I've taken half my harvest, and that machine that I bought actually extracts the seeds to where I can replant the next year. This is just sans seeds that are really for decor on my stand because I planted some flowers. And I would say that seems reasonable. I would consider putting that in the jam stand decor. And that would be your call in terms of whether or not you want that combined in there or not.
So it's definitely the business owner's decision how they want their accounts to look and how they want these reports to look. But there's a lot of kind of paying attention to common sense, making sure that it's simple enough that an outside accountant or someone reading the financials can actually understand what it is that you're trying to do and what the numbers mean.
That's exactly right. So it's entirely at your discretion. My advisement would be you can expand the chart of accounts as much as you want. Normally, my inclination is to combine things to the maximum extent possible, and that would be my recommendation. But we still have a pretty short chart of accounts. So if you really wanted seeds separately from decor, that's perfectly fine in this case.
Great.
And then continuing down the list, phone and internet charges, legal and professional expenses, those are all reasonable.
Mhm.
So overall, whenever I look, $3,800 loss, Catherine may see that and go, it's over, I failed. That is not the case. She still made positive cash because whenever I look at things in this profit and loss, there's some items which she hasn't really spent money on. So depreciation is the best example. If we exclude depreciation, which isn't a cash outflow expense, we still made money. We may need to make more later in order to reinvest in equipment if we ever need to. That machinery is not going to last forever, but this is not the end of the world. This is not uncommon for a new business owner. You're taking depreciation for your newly purchased equipment to where you're not going to run a profit on paper, but you still may have extra cash.
Definitely. And just to, before we move on, just to again emphasize for people like me, whether or not like numbers are something that like freak you out, or whether or not like whatever you want this account of report to look like, it seems like applying common sense rules to just gut check yourself. So if something looks high, definitely look into it and see if it looks high. You're going to be the one that knows what should be high, what isn't high. whether or not a number should be negative or not, kind of going back to the balance sheet rule. So
Yep.
a lot of this is about setting it up the way that works for you and your business, and in a way that you can understand as you continue to add to your financials.
Yes, exactly. So the statement of cash flow is a link between the balance sheet and the income statement. It's an explanation of how has my cash increased or decreased, once again, over a set period of time.
Mm-hmm.
It's a reconciliation between your operations and your cash flow, essentially.
Okay.
So let's just skip this one and go straight into the actual very good GM. So once again, we've created a statement of cash flows based on the actual operation of Catherine's company, Very Good GMs. So the way a statement of cash flow works is it's divided into three separate sections. We have operating activities, investing activities, and financing activities. And we take the net cash flow from those and we decide, or we calculate whether or not it's been an overall increase or decrease in cash. And that should reconcile then to our balance sheet from our beginning cash balance to ending cash balance.
And can you remind us, what does cash mean?
Cash is, it's technically a short-term investment. Just think of it as your bank account. It's just your bank account.
It's not like $20 bills on your desk. It is the amount of money that you have available at that time. Is that a good description? Or
that is, that's a good description. So it's your book balance, which there can be outstanding checks, outstanding deposits, which impact book balance versus bank balance. So it's your book balance of your cash. In regards to if you have cash scattered all over your desk, I would suggest you deposit that in the bank. There's funds for petty cash, which are normally ignored for most of the year and kind of reconciled at the end because they're normally immaterial. So don't have cash scattered all over your desk.
It's not a good idea, but I think cash is something outside of accounting. Like, when do you even refer to it anymore?
Yeah.
You don't.
Yeah. So we have someone that wants to be a guest on the webinar about to walk in.
We'll keep doing the webinar.
So we start with your net income, which this is your net income. If we look, it was a $3,800 loss. That matches our profit and loss.
Go back.
Yeah.
I'll show that.
So look at your net income at the bottom, $3,800.
Kind of re-emphasizing that this is a connector tool.
Exactly. So we've lost $3,800 on paper. Now we're trying to figure out where we got to, how we ended up cash flow wise. So next, the first thing is the operating activity. So that is your operations of your business. How have they impacted your cash flow? So for example, we referenced depreciation last time. We lost $3,800, but in reality, we had $5,000 of depreciation, which is a non-cash transaction. So in reality, we end up $1,200 positive there. There's other items in the operating section. So we've had an increase in accounts receivable. Remember, we've declared that revenue whenever we've declared that receivable, but we haven't actually received the cash yet. So if that's in our income statement, we need to back it out. Same thing for changes in inventory. As we buy inventory, we don't necessarily just expense it right away. That is an option, but in this case, we haven't because we're doing accrual basis financials. So we bought our inventory. That has not hit our profit and loss yet. It's sitting on our balance sheet. So our inventory increased by $1,500. We've spent money on that to get it, but we haven't expensed it yet. So we back that out because we've spent cash on it. Increase in AP and credit cards. So AP is accounts payable. We haven't paid these vendors yet because we don't have to because we're good business owners yet. We'll pay them at the end of the term limit, or if we get a discount, which is a possibility that you should pay attention to on your invoices, by the way, we'll pay it then in order to get a discount on our payment. So in this case, our AP and credit cards increased their balance by $7,800. That's okay. So net, our operating activities have provided us $4,000 positive cash flow, which is just a sum of all those upper sections. The next section is in the investing activities. So whenever I think about investing activities, I'm thinking about large capital expenditures that I'm using to grow my business. In this example, Catherine's bought $300,000 of land, as we all remember, and a $35,000 piece of equipment in order to extract seeds from strawberries to reduce their seed costs in future years. So that's obviously a cash outflow. So that's $335,000 out the door.
And investing in this particular instance means like money that I have invested or like that has been invested into the business.
It does not. It is money the business has spent on what you could think of as investments in itself.
Okay.
So the next option, the next section, which is kind of what Catherine was alluding to, is the financing activity. So how we're actually acquiring these large capital investments, these large capital assets. We can either contribute cash ourselves. If Catherine has $335,000 sitting, waiting to be put into a business.
Boy.
She could have bought that land and equipment with that. In this case, she didn't. She took out a loan of $335,000 to pay for it in its entirety. And then she also put another $9,500 in of her own money in order to fund the operations of the business. So we started this business with $0, obviously. If I add up my investing, my financing, and my operating activities, overall, it turns out that I have made $13,500 in cash, which that should tie to our balance sheet number. And if we go back there, if we look at current assets, and the second line there, cash, $13,500.
That's exciting. So this is the connector report that bridges the two, the balance sheet and the income statement.
Exactly. And it also may give you a little peace of mind of, I see $3,800 loss in the income statement.
Mm-hmm.
How am I going to pay my bills?
Mm-hmm.
If we look at it and we see, okay, well, I've actually brought in $13,500 and only $9,500 of that was my own money. I've really brought in $4,000 then, which in that case is from your operating activities.
So this is like a summary report of everything that we've just looked at together.
Exactly. It's exciting. So the statement of cash flows is probably the hardest report to understand of the ones that we've looked at today, because it's building on two different sets of financial statements. But once you learn to use it, it can be very helpful for you in determining how effectively your business is producing cash. For example, if we operate for another 6 months and Catherine starts paying cash towards loans, as long as that cash is covering the loans plus whatever she needs to live, that's great. If it's just covering the loans, she may see positive profitability, but in reality, she's losing cash, which can be a problem. We may need to adjust how we're doing business. Yep.
This is a sneak peek of New Business 101. You may be asking yourself at this moment, how do I customize these reports? Where does budgeting fall in? How do I expand the financials to meet my specific metrics?
What's an invoice?
What's an invoice? All of these things we're going to cover 2 sessions from now in New Business 201. Where we'll be talking about customization to your industry and for the numbers that you're looking for. Yeah. So stay tuned.
All right. And then lastly, we just want to touch on accrual versus tax financials, or I'm sorry, accrual versus cash financials. I recommend that you keep your financials in the accrual basis because it's more reflective of what's going on in reality. It lets you look forward versus just what's currently hitting your bank account. Cash financials, you can think of whatever money's coming in and going out outside of loans and certain other things I can basically consider income and expense. Accrual is I've completed my work, I'm owed money. Mm-hmm. That is revenue. I will then have the ability and should be following up on that revenue to make sure I get paid on it. So accrual basis is revenue is booked when it's earned, not when you're paid, and expenses are accrued when they're incurred, not when they're paid. So if I provide $2,000 worth of field work for Catherine and she doesn't pay me yet because I said she didn't have to pay me for 30 days because I'm a very successful field hand. Mm-hmm. Yeah, something like that. She would record that expense under the accrual method immediately upon the completion of my work. If she was a cash basis taxpayer or cash basis books, she would not record it until it was actually paid. Now, accrual versus cash taxpayer, I recommend you do whatever's most beneficial to you. If you primarily,
as an individual, what do you mean taxpayer?
so businesses, in this case, you can either be accrual basis or cash basis. So all income from entities flows through to owners except for C corporations.
Okay.
So you may have a separate business tax return. You're not going to pay income taxes on it, that you'll pay at your personal level. You make an election at the business level, whether you'll be an accrual basis taxpayer or a cash basis taxpayer. If you primarily operate where you have large receivables and low payables, it's going to be a benefit to you to be a cash basis taxpayer because you don't have to pay on income that you haven't received yet.
Mhm.
So it saves you cash out of pocket until you actually receive that money.
Mhm.
If it's the opposite, you want to consider being an accrual basis taxpayer. So if I incur expenses, but I don't have a lot of receivables, it may be beneficial for me to be an accrual basis taxpayer because essentially I can accelerate my deductions and I don't have a lot of downside with having to declare income.
Okay. Can you switch back and forth? Like, let's say you decided that one or the other just isn't for you. Can I just change?
You can change. I believe the rule is you can't just flip back and forth each year depending on what's most beneficial. I think that there's a 5-year window where you're not allowed to keep switching back and forth once you elect one.
Why would that be?
To prevent people from abusing the tax system.
Okay.
So how can HKA help? We've gone through financial statements the last 2 weeks. What can we do to help you as a business owner? You can either engage us to prepare your financials on your behalf. We can train you to teach you how we recommend you set up your financials that would be helpful to you. We can come in the very beginning and just help you set up, or we can come in every quarter just to kind of check on the overall quality of them and then make suggestions along the way. We can help you determine what reports or what key performance indicators based on your numbers are important to you. So we just have lots of experience looking at these financials over and over and over again, which gives us more insight into them than the average new business owner has.
I think like previous webinars, we had a much longer list of how we could help. Since we just covered different financial reports today, it seems like a smaller list, but just to re-emphasize any step of the business that you need assistance with, that's what we're here to help you with.
Yep. Catherine, do you want to tell them about next week?
So next week, like we said, are going to be doing that sample chart of accounts just to show you a few different ideas for your industry and to talk about some best practices. We're also going to talk about expenses. What can you deduct? What does it mean to deduct? How should you be categorizing those expenses within your accounts? And again, all of this is customizable. So the things that we go over, you're going to want to apply for your own business and the industry that you're in. But just to kind of push you off on the right foot and give you some ideas. We're also going to be embarking on New Business 201 in 2 weeks, which, like we said before, is all about customization and starting to use the financials really for you. Yeah. So Session 5 is going to be entering budgets for comparison so that you can start to see if you're hitting your budgets. We'll also talk a lot about why it's important to have a budget. Section 6, we're going to be talking about customization, like we discussed earlier, expanding your financials to specific metrics, doing classes and categories if that is something that would work for your business. Session 7, we're going to talk about taxes, how taxes work for businesses, which we get a lot of questions on and we happen to be specialists on. And then Session 8 will kind of be wrapping up some more considerations, best practices, etc. So looking forward to doing those sessions. And this is our contact information. Please don't hesitate to reach out if you have questions, if you need assistance with your business, or if you just want to talk some things through, feel free to contact myself or Jordan, and we will put you in Jordan's calendar.
Thanks, everybody.